Hello everyone and welcome back to a new video. As always, if you enjoy the content, make sure to leave a like and subscribe. So I haven't really been trading much because of this insane volatility that has been going on for a while now, and I really don't see this volatility coming down anytime soon. So that being said, I have decided to switch up my strategy a little bit, which also explains why I deposited $1,000 more into the account. But you guys remember about a week ago I mentioned something called the wheel strategy, but I never actually went into details explaining to you how it actually works. And like I said, because of the implied volatility, I think this is going to be the strategy that I will be using for the foreseeable future right now, just because it's very effective in the sense that you're guaranteed profit no matter what a stock does. Obviously, you do need a little bit more capital in order to make a decent gain, which also explains why I deposited $1,000 more. But overall, it's a pretty safe strategy because, like I said, you're guaranteed to make money if you play it correctly. So, the positions that I have right now is I have 100 shares of Wells Fargo Bank, but I didn't just buy the 100 shares of Wells Fargo because, like I said, this is the wheel strategy and it goes around in a circle. So basically, the way I entered this trade and the way I ended up having 100 shares of Wells Fargo was, if we go back almost 2 weeks ago on May 11th, if I can find the order right here, May 11th, you see, I entered a trade that was for a Wells Fargo option of a put at a strike of $24.50. And I got a total credit of $50 for that. So basically what that means in terms of options, because I didn't actually buy the option, I sold it to open. So basically what that means is that I get the $50 credits and I keep the option, and basically if by the time this option expired, Wells Fargo was above $24.50, then I would have to buy 100 shares of Wells Fargo at $24.50. So like I said, it ended up closing below $24.50, so I was forced to buy 100 shares of Wells Fargo at $24.50. But Wells Fargo is a relatively stable stock and a good growth stock because it has a dividend, so I really don't mind owning it. That and the premiums on the options are pretty good. So this is a strategy that you wouldn't want to do like on a penny stock or anything. This is something that you would do on a stock that you don't mind owning. But like I said, I ended up getting assigned, so I still kept the $50 credits, which is what I mean by guaranteed profit. But now I had the 100 shares of Wells Fargo at a price of $24.50. So what I went ahead and did was turn around, and instead of selling a put, now I can sell a call because I have the 100 shares as collateral. So that's exactly what I ended up doing. I ended up selling the $25 call for this week, and it actually expires tomorrow. And as of right now, it looks like it's going to expire worthless, which in our case, we really don't care if it expires worthless or in the money, because if it expires worthless, we get to keep the full $42 in premium, which is what we initially got for opening the position. But if it expires in the money, we're still going to make money, because if you think about it, we still get the $42. But because we sold the option at a strike of 25 and our average cost of the 100 shares are at $24.50, we would profit the difference. So it's a 50-cent difference, and we have 100 shares, so we get a total profit of $50. So in total, if tomorrow Wells Fargo does end up going above $25, which I really don't see it happening, we would profit a total of $92. If it doesn't, we're still going to profit the $42, which is what we got for opening the option. But we still get to keep the 100 shares, and we could repeat that over and over until we get assigned on the call side, and then our shares get called away, but we still make the profit. And so when that does happen, eventually, I'm going to do the same thing and go over and over. It's basically like a circle, once they get assigned and they get called away, we can go ahead and sell some more puts until we get assigned. And then once we get assigned on the put side, we're going to have these shares as collateral, and you could sell calls against it. So basically, you're selling naked puts until you get assigned, and once you get assigned, you're selling covered calls. So I know this might be a little bit confusing to some, and I hope I did a good job at trying to explain this strategy, because it is definitely a really solid strategy on a stock that you don't mind owning, because like I said, you're guaranteed profit no matter what the stock does. Like if it goes up, it goes down, we're still guaranteed profit at the end of the day, and that is why it's such a good strategy. But like I said, I might not have done a not good of a job explaining, just because it's not necessarily a beginner strategy, just because it has many different components. But if you guys have any questions, you can just leave it down in the comments or join my Discord chat below and just ask me, and I'll be more than happy to explain them. But that's pretty much it for this video. I will see you guys in the next one.